Hi, good evening. I'm Alok Nandi of forex consultant, talking to you on events of the last 48 hours or 72 hours, which have brought tremendous changes and impacted the trading of foreign currency derivatives in India. To start off with what happened, to start off, on 5th January 2024, RBI brought out a circular, a master direction, a new amended master direction, which compiled the amendments of all the previous circulars on currency derivative trading. In effect, the new circular did not really contain too much of a change. I will make it very clear that all the circulars, including the 5th January, did make it very clear that the authorized dealers or exchanges should ensure that users of this facility have an underlying FX exposure. They also said, after various amendments, that up to a limit of $100 million, positions can be taken by users without producing evidence or documents validating the existence of an underlying exposure, which basically meant that the exchanges can allow traders, users who have to be residents of India, to trade on their exchanges without having to produce documentary evidence of the underlying exposure. But the exchanges should also make it clear that should the user be required to produce such evidence, he shall do so. This is something which was there in all of the circulars relating to FX trading on exchanges. Over the last 10 years or so, residents have been trading on the foreign currency platforms of NSE and BSE and others, under the presumption that since these exchanges were authorized by Sebi to provide this facility to the users, such exchanges would have fulfilled all the norms required, which primarily meant that they should have warned the users that there should be the existence of an underlying exposure. And while they might not have to produce such evidence at the time of trading, they might, if required, if deemed necessary by the exchange, produce such documents. Now, this was something which was not really emphasized by the exchanges, either to the brokers who were on their platforms or by the brokers to the users, normal traders who were trading on currencies as they were trading in equity market. This argument gathers much more strength because after a few years of the existence of currency derivative trading on the FX platforms of NSE and others, RBI increased the limit the original limit of $10 million for every individual trader to $100 million. It was assumed by all traders, and very rightly so, that since RBI has increased the limit from $10 million to $100 million, a 10-time increase, they must have analyzed trading which was already happening before that to come to the conclusion that the market required such a limit. The traders therefore assumed that everything was all right with the way they were trading. The fact there has not been a single case, a single known case of default on foreign exchange currency derivative platform by any trader or by any broker brought strength to the fact that traders in foreign currency derivative were primarily professionals or people who had exposure to FX or people who understood foreign exchange. So there was no alarm in the mind of users, and there was no need, or they felt no need to study all the circulars of FEMA and RBI because the services and facilities were being offered by Sebi, an authorized government of India, an institution founded by a parliamentary act, an institution which controls and which regulates the equity markets, the commodities market. So as long as Sebi was authorizing the brokers to offer this platform or NSE to offer this platform to the traders, there was no need for the traders, or they felt there was no need to go back and check every circle of RBI under the FEMA or any other amendment to see if what the exchanges were offering was in line with the regulation. Perhaps the brokers on whose platforms most traders were conducting the transactions also felt no necessity of asking or warning their clients or cautioning their clients that trading has to be done on the basis of the existence of an underlying exposure. Because that would have meant that only exporters and importers or people with foreign currency exposure like debt or anything else would be able to deal on the exchange and not any other individual trader. When the brokers and Sebi and NSE saw a huge number of such individual trades on their account, and mind you, they were aware that these are individual traders, not corporates. They're not companies like import companies or export companies, small, mid-size or anything. It was practically 80% of the transaction or maybe 90% of the transactions were being done by individual traders. Sebi should have alerted RBI or should have alerted the broking houses or the NSE that look, you need to caution the users, the traders, that they must have an underlying exposure. They might not provide documents at this stage, but if asked, they should be able to provide that. So looking at it, it seemed perfectly normal for users to use that, especially as there was never a doubt, never a smell of any kind of default or any kind of disruption in the system due to the use by users. While RBI might feel itself protected by the fact that these circulars were there which said that dealers, traders or users of the facility should have an underlying exposure. When they increased the limit from $10 million to $100 million, they would have analyzed that 80% or 90% of the trades were done by individuals and not by any corporate clients. At that stage, they should have warned the exchanges and they should have warned the brokers that you must caution your users, your clients, that they must have an underlying exposure. If that had been done, traders would have taken the precaution, and those who did not have that underlying exposure would have stopped trading. However, traders were encouraged with the very fact that various RBI officials and Sebi officials were upbeat on the growth in volume in currency trading, derivative trading, and the depth they provided, the liquidity they provided to the forex markets. At no stage till 5th of January, till the 1st of April 2024, did they bring forward any discomfort on their part about the users not having underlying exchanges. Now, what happened on 5th of January was that the circular which came out basically reiterated what was there in the previous circulars. There was nothing new. But what was interesting, and which was overlooked by nearly everybody, was that it said that this would be implemented from the 5th of April. Since there was no major change in this thing, and RBI did say that its stance on derivative trading has not changed, nobody paid attention to the date of 5th of April. As 5th of April approached, first being a holiday in the FX market, but not in the commodities or equity markets, on 1st of April, Commodity Exchange Brokers Association sought a clarification from RBI as to whether they should or could continue to trade as before after the 5th of April. And surprisingly and shockingly, the response from a CGM of RBI in his mail to the brokers, in his letter to the brokers, said that RBI's stance has not changed. It continued to be the same. But he added in a separate small para that violation of the regulation would be a violation of FEMA. FEMA states that every foreign exchange transaction should have a commercial exposure. It could be an export and import or this thing, but it was not meant to be a speculative transaction. But when RBI started the currency, allowed Sebi and NSE to provide this facility of currency derivative trading to traders, they never warned or cautioned the traders that all trading in FX would be as per the FEMA this thing. All trading, even in currency derivative trading, would be in accordance with the FEMA regulations. Because had they done so, the brokers and others would have immediately checked and said, and would have seen that they cannot do a transaction without exposure, without a commercial exposure. However, like I said before, Sebi did not warn brokers, brokers did not warn users, and things went on for years together. When such a regular thing becomes a practice, when the traders who come in after 5 years or 6 years, the users, they do not go back to every RBI circular to see what was the actual RBI this thing. They believe in the credibility of Sebi. They believe that the Sebi has the authority, the right authority to permit NSE and others to have such a foreign exchange currency trading, derivative trading facility, and to provide such facilities to resident Indians. So it will be very difficult to imagine that any user would have, before starting trading, would have gone back to check every facility, every circular of RBI as it related to foreign exchange trading. Now on 1st April, when the Forex Commodity Brokers Association got the response from the CGM RBI that what they were doing was in fact a violation of FEMA, and FEMA is a dreaded and draconian act. A panic set in among the brokers. It soon, when the markets opened, when the currency derivative markets opened on the 2nd of April, there were strong rumors flying around that currency trading is being stopped. The next day, on 3rd, it was debated, or it was at least mentioned in financial media, that such a thing was happening. RBI's letter to the commodity brokers was circulated, and thereafter brokers informed their clients that they should cut off all their position by the end of trading on 4th. However, those who had actual forex exposure, commercial exposure, could continue to do so after filling up a form which indicated that yes, they had that exposure and this was the exposure, and that was on the basis of that exposure that they were trading in the market. All others, which meant nearly 90% of the users of the currency derivative facility, were retail traders, speculators, people who were arbitraging. And the important thing was that out of this 90%, nearly 90-95% were people with positions of less than $1 million. Rumors then started around the market that a couple of large corporates or large brokers have misused the facility. Whatever be the issue, on by the 4th of April, most traders were forced to cut off their position. They did so, or otherwise they were, because the brokers had threatened that they would automatically square off the position by 4 o'clock. So it was assumed that nearly every trader who had a position, retail trader, would have closed the position, maybe at a major loss. The funny thing was that at no time till 5 p.m. of today, on the 4th of April, did RBI come out and say or offer any clarification or any kind of official statement about what was happening and what needed to be done. It is pertinent to mention that on 1st of April, around 7 million positions were open in the currency derivative section. Most of them were for the first month of April, and then the others were for various other months. By 3rd, when the broker started calling up the clients and telling them that unless they had an commercial FX exposure, they should cut the position, the open position limit had come down to 3.5 million, approximately 3.5 million open positions, as most traders started cutting their position. And by the 4th afternoon, it had come down to 2.2 million. There were some vague rumors on the afternoon of 4th that some officials from some government institutions, regulatory institution, had called up some brokers and told them not to cut their position. They were asked to remove all their bids and offers in the market, but not to cut positions. I cannot confirm whether such a call was made by, say, any institution to the brokers. This is purely hearsay, and I wish some broker who had received such a call would confirm it by commenting on this video. At the close of the day, it was surprising that there were still 2 million open positions in the market. The markets were absolutely stable on the 2nd, 3rd and 4th of April. The movement was just 8 to 10 paisa, which was normal. So if 5 million positions were covered without creating a liquidity problem, Why weren't the 2 million open positions covered? Why did the brokers not close those positions? Did they have any inkling that such a circular was about to come? Nobody had any idea, because RBI till 5 o'clock at the expiry of the trading, RBI had not issued any clarification, any circular. And strangely and very shockingly, after the markets had closed on the 4th, RBI came out with a circular stating that they're extending the date from the 4th of April to the 3rd of May. By which time most of the traders had closed their positions, most of them at a loss, except for the traders who had 2 million open position. It is very pertinent to ask as to why those traders with 2 million open position not cut their position. Why did not the brokers or Sebi feel it necessary to tell the brokers to cut off all positions? Why did they not do so? RBI in its press release mentioning the postponement of the implementation of that from 4th of April to 3rd of May, did not mention anything about the positions which were still open, did not mention anything about the fact that this was coming after the markets had closed, did not mention anything about the fact that most traders has already cut their position by the end of the day, taking huge losses at times. So RBI needs to come out first and say, why was there a delay? Why was no such circular issued on the 4th or the 3rd, clarifying the situation or extending the period? Why did the brokers force traders to cut their positions? Had RBI issued a circular on the 1st or the 2nd or the 3rd, they would not have done so. So why did RBI wait for the close of the market, by which time everything had been already done, to come out with an extension? How can you come out with an extension of a circular which is already expired, the effect of which had already started? As of 5th morning to start. Market is closed from 5 p.m. on the 4th till the 5th morning. What did RBI expect would happen after they came out with a circular after 5 p.m. on the 4th? Would they expect any new positions to be created? Would they expect that did they expect that people would not cut their positions because they knew or expected RBI would issue the circular? It is shocking that RBI did not think it necessary to issue the circular on the 2nd, 3rd or 4th. And it is equally shocking that RBI has not mentioned neither RBI nor Sebi have mentioned anything about investigating those 2 million open positions. Who had the positions? Were they the ones who were informed by some officials in a regulatory institution not to cut their position? Was that official of the regulatory institution aware that RBI will come out with an extension? In which case these brokers with users with 2 million open position could then square off the position with the next one when the market had cooled down and dollar had come to a level where they could do so without a loss. This is nothing but RBI and Sebi taking people for a ride. As simple as that. Somebody or something must have been involved for people to hold on 2 million open positions, despite the fact that brokers had asked them to cut their positions, despite the fact that it was there in every financial media that the positions had to be cut, some said by 2 p.m., but whatever, by the end of the day of 4th of April. I think people who have made money or lost money, whatever be the case, have a right to get an explanation from RBI and Sebi as to why for nearly 10 years Sebi did not caution this thing, as to why RBI increased the limit from 10 million to 100 million, and at no time in any press conference, in any press conference of RBI governor after every MPC meeting, did they ever caution that, look, the currency derivative trading is only meant for people with actual exposure, small exporters, small importers. There was no such warning. Was RBI waiting to trap people? And this also brings into question, why did RBI bring up huge reserves to $342 billion? Why did RBI buy $60 billion in the financial year 23-24? And why did RBI buy about $20 billion in just last 3 months, January, February and March? There was no volatility in the market, but RBI kept on buying dollars, pushing the dollar up. Were they trying to trap users, knowing very well that the people are not really using the currency derivative market for trading without an underlying exposure? They were aware of it because Sebi was aware of it, the brokers were aware of it. Was it a trap being laid by RBI? If it is so, it does not do anything for the credibility of a regulatory institution. RBI's job is not to try to trap people into doing things which might not have been done. But RBI must remember that people were trading on an exchange or on platforms which was authorized by Sebi, which was authorized by NSE. And at no time did NSE or Sebi put any warning on any of the platform that you will trade only if you have a commercial exposure. I think we need to talk about it, bring it out in the open. I'm surprised that the financial media, even today after 5 o'clock, when they came out with the news of the RBI, they talked about RBI always saying that their stance has not been changed. But none of them ever questioned RBI as to why the circular was issued after 5 p.m. when there was no news, when there was no need for such a circular. What is the need of extending the deadline from 4th evening to 3rd of May? Because everybody had cut their position. In whose aid was the circular issued? After the expiry of the previous circular. As of 5 p.m., when the currency future market closed, the previous circulars had all expired. The term of the previous circulars were all expired. And you cannot extend a thing which is already expired. I think these are questions that need to be asked. I will keep following this up. I will try my best to talk to as many people as possible and to ask RBI and Sebi to come out with an official statement. Tell us who are these 2 million open position holders? Why were they allowed to do so? And what action would RBI and Sebi take under the FEMA against these people? Unfortunately, in India, unlike in US and other places, RBI doesn't have to answer to anybody. RBI's meetings with the parliamentary committee is not made public. In US, for example, the Fed goes before the Senate Banking Committee in camera, where he's asked questions about the strategy and other things. In India, there is no such thing. Nobody knows why is RBI buying dollars at 83 this thing. Why is RBI pushing the dollar to 83.30? It could have valid reason, but there's not a single news item or any detailed report as to what happens in this committee. What questions is RBI asked? I very much doubt if RBI has ever asked a question about its strategy of FX reserves. So it will be my effort to try and bring this to the notice of people who are in the Parliament Committee and ask them whether they have ever asked RBI about such thing, or whether they will in the coming days ask RBI as to why did they issue the circular after the expiry of the previous listing, and which forced people to cut, normal traders to cut their position. We will not leave it at this. We will take it forward. And I'm making a wholehearted plea to all of you to please support us in this. Please like this, subscribe, no payments required, and share this video so that the word can spread around. Because the media will not do anything. NSE will not do anything. SEBI will not do anything. Major brokers will not do anything because they all work under the control of NSE and SEBI, and they have other requirements. Currency trading, derivative trading is not their priority sector. Even in just a simple case, all banks are required to ask their customers as to their exposure before they are allowed to trade in the FX. An importer cannot go and buy $1 million from a bank forward. He has to tell the bank what his exposure is. He has to show the bank. If that was the reason, if it made sense, then why did it not make sense for SEBI to put such a thing in bold public notice that you have to have FX exposure? Nobody would have traded then. But what RBI and SEBI put together have done is harmed a lot of unsuspecting traders who have been trading not for 1 month or two, for years together, with no idea that they were in violation of FEMA circular, because FEMA was not mentioned at all in any warning by SEBI or others that users of this facility is only limited to those who have exposure in FX. And why did RBI make a exception that users need not show their documents or provide evidence of such exposure at the time of taking the trade? They might, if asked, provide such statements, such documentary evidence. Why? Why make it optional? If it is a violation of FEMA to trade like that, RBI could have said in circular that this facility is only meant for people who have commercial exposure in foreign exchange. This is something which will have a negative impact on India's image, on RBI's image, credibility in the international markets. RBI might not feel the backlash today, tomorrow, day after, but it will be there. The trust that RBI has built up will die very soon, will take a huge dive. If RBI uses its regulatory powers to trap people. Like I said earlier, its business is not to trap innocent people. Its business is to regulate the market, to warn people that what they are doing is not in line with the regulation. In fact, if you look at the last press conference of the RBI governor after the last MPC meeting, he said RBI does not take action immediately. It wants this thing. It brings it to the notice of the company or this thing which is violating. This was in relation to Paytm. He said openly that we do not take such actions immediately. We bring it to the notice of them and give them time to rectify. But here RBI did not bring it out in the open. Tell openly that you are violating FEMA if you don't have an underlying exposures. 3 simple words. We feel it was a trap laid by RBI. To what purpose, to aid, to help whom, we do not know. Why was the circular issued after the expiry of trading hours or forth? We do not know. Somebody needs to answer. Somebody needs to provide these answers. And since the financial media, who are dependent on RBI and SEBI and others for patronage, will not do so, we have to do it. And I expect and request your help in taking this forward. Thank you.